The Reserve Bank of India, RBI, is the central bank of India and is responsible for formulating and implementing the monetary policy in the country. The RBI's monetary policy plays a crucial role in regulating the money supply and credit in the economy, thereby influencing the overall economic growth and development. The RBI's monetary policy is based on various macroeconomic indicators such as inflation, GDP growth, fiscal deficit, and balance of payments. The RBI sets the key policy rates such as the repo rate, reverse repo rate, and cash reserve ratio, CRR, to manage inflation and growth in the economy. The repo rate is the rate at which the RBI lends money to commercial banks, and the reverse repo rate is the rate at which the RBI borrows money from commercial banks. The CRR is the portion of the bank's deposits that they have to keep with the RBI as a reserve. When the RBI increases the repo rate, it makes borrowing costlier for banks, which reduces the money supply in the economy and helps control inflation. On the other hand, when the RBI reduces the repo rate, it makes borrowing cheaper for banks, which increases the money supply in the economy and stimulates economic growth. Similarly, the reverse repo rate is used by the RBI to regulate the liquidity in the economy. When the RBI increases the reverse repo rate, it encourages banks to deposit their excess funds with the RBI, which reduces the money supply in the economy. Conversely, when the RBI reduces the reverse repo rate, it discourages banks from depositing their excess funds with the RBI, which increases the money supply in the economy. The CRR is used by the RBI to control the amount of money that banks can lend. When the CRR is increased, banks have to keep a higher portion of their deposits with the RBI, which reduces the amount of money they can lend. On the other hand, when the CRR is reduced, banks have to keep a lower portion of their deposits with the RBI, which increases the amount of money they can lend. Apart from these key policy rates, the RBI also uses other monetary policy tools such as open market operations, OMOs, the marginal standing facility, MSF, and the liquidity adjustment facility, LAF, to manage the liquidity in the economy and control inflation. Overall, the RBI's monetary policy is a crucial aspect of the Indian economy, and its decisions have a significant impact on the country's economic growth and development. Please note that it is an AI-generated video, so there may be few corrections needed. Thank you viewers for the time. Please do like, share this video and also subscribe this channel.